Did Repo save the share market? Let's have a look. Hello everyone, Florian Heise here and welcome to another episode of HeiseSays. I have my stein of coffee and I thought we'd have a look at a few articles and discuss the repo market here in Australia because we had, well, a fantastic turnaround for the stock exchange today. It was under, well, the ASX 200 was under 5,000 and it closed at, I think, over 5.6 or 5.5. Crazy. So let's have a look at a few takes on it and discuss the repo market, which I have a theory may have had an effect on this. So, Aussie share market's death spiral halted on a stunning rebound. It's been a hell of a week. An extraordinary swing of more than 12% saved the ASX from recording its worst ever result. Okay? Analysts and investors have been left speechless by a stunning rebound on the Australian share market this afternoon, with a swing of more than 12% closing out a historic week. The ASX 200 closed 4.4% higher at 5,539 after earlier plunging as low as 8%, only narrowly avoiding the worst week of losses in its history. CMC Markets chief strategist Michael McCarthy said the trading floor had been caught completely off guard by the resurgence that began shortly before 2:30, leaving analysts to widely speculate the cause. Okay? So the analysts didn't know why it was happening. Or so they say. It's interesting. I was looking at this morning. And on my trading platform, I think 71% of people were long on the ASX 200, which I think could be a sign. You know, you'd expect it to improve a bit after a drastic fall, particularly with the stimulus spending coming from the government. That might prop it up a bit, wouldn't you? But it's this much? Finishing the day 4% higher? Let's have a look. The market had just gotten back through 5,000 and it looked like a big cash buyer stepped up to the plate, and it has basically then rose from then on all the way to almost 3:30 p.m. he told news.com.au. It rallied 450 points in less than an hour. It's an extraordinary move. And I was having a nap while this happened. Oh well. As the final bell rang at 4:10 p.m, a loud cheer could be heard from exhausted traders left to lick their wounds after the ASX lost 232 billion over the 5 days. It's been a hell of a week. A lot of people are very glad to finally hear the closing bell, Mr. McCarthy said. The market has now lost 529 billion since its all-time high reached just 3 weeks ago on February 20. We've never seen anything like the intensity and the ferocity of the selling. There's no script to show how aggressive this sell-off has been, Pepperstone, head of research, Chris Weston said. He said US President Donald Trump's inaction to counter the economic impacts of the illness, coupled with his 30-day travel ban to Europe, were the main prods for the spiral. At midday, Australian time yesterday, Trump ramped up travel restrictions and was flimsy on details of a promised stimulus package proposed to ease the looming financial crisis. He basically brought a pea shooter to a gunfight, Mr. Weston said. The Trump administration is not delivering shock and awe when the markets really needed it. They needed to go above and beyond when they had the chance, and they disappointed. Berman Chief Investment Officer Julia Lee said the weight of money shedding from the markets this week hasn't been witnessed for more than 30 years. It is historic. It's a historic move we've seen in terms of the market. It's the worst we've seen since the 87 stock market crash, she told news.com.au. The speed of the losses is unusual, but when volatility does spike, it tends to cluster. It's just that we're seeing extremely big moves. So, I mean, there you go. This is today. That's 1987. Okay, and well, it's gone back up, hasn't it? So look at the red there. Ms. Lee said the market sees big moves both downward and up during times of such uncertainty, but the trajectory of global stocks is certain. In the last couple of weeks, Wall Street has had plus negative 4% days as well, she said, and you would expect that in this kind of environment. We see big up days, but ultimately the down days outweigh and the market continues to go lower until it finds a floor. So Thursday's historic tumble. Yesterday's falls eclipse the pain inflicted on Monday, making it the worst day of losses since the GFC. The ASX plunged 7.4% to 5,304 by the close on a day 35-year veteran CMC Markets chief strategist Michael McCarthy described as one of the worst he'd ever witnessed. The global impulse is really crueling the local market, he told news.com.au, and the steepness of the falls and the speed of the falls suggest there's more damage to come. The local index reached an all-time high of 7,289 on February 20, but has plummeted more than a quarter in just 3 weeks, amounting to an astonishing loss of $500 billion. The steep falls were inflicted across the board, but the energy and banking sectors were particularly smashed, each down 8%. Major lenders, Commonwealth Bank, Westpac, NAB, and NZ, were all between 7.8 and 8.8% lower. Travel companies remain the worst impacted by the illness, and increasingly severe travel restrictions. Both Webjet and Flight Centre fell nearly 20%, while Virgin was down 16.7%. Now, this piece was published at 5:16. And is there something missing here that James has missed, that he hasn't mentioned? Which was surprising. No mention of the repo market, particularly when we just read it in a previous piece. And we'll jump here. The ABC has prepared something as well, and this was 2 hours ago. Australian share markets have a huge turnaround despite global markets tumbling again overnight, and the illness ban. And we'll scroll down here, travel spooks investors. And here the RBA pumps extra cash. Meanwhile, the Reserve Bank injected an unusually large amount of cash into the financial system on Friday amid the global panic selling, which could push up borrowing costs and potentially drain liquidity or the ability to pay debts from cash reserves. In its daily monetary market operations, the RBA pumped $8.8 billion into the system through repurchase agreements, well above the estimated requirement of $3.4. The money was lent to banks for periods ranging from 17 to 95 days. Okay, so let's have a look a little bit more about the repo market, because to be brutally honest, I had absolutely no idea about this market, that repo existed, until I started going down this crazy ride that is learning about just the financial market and what's happening to the global economy, and slowly turning into a gold bug. But the more you learn, I think the more you become a gold and silver bug. So let's jump over to one of my favorite websites, Investopedia, and we will read through a little bit here. So repo, it's a repurchase agreement. So a repurchase agreement, repo, is a form of short-term borrowing for dealers in government securities. In the case of a repo, a dealer sells government securities to investors, usually on an overnight basis, and buys them back the following day at a slightly higher price. This small difference in price is the implicit overnight interest rate. Repos are typically used to raise short-term capital. They are also a common tool of central banks in their open market operations. For the party selling the security and agreeing to repurchase it in the future, it is a repo. For the party on the other end of the transaction buying the security, which would be the Reserve Bank, and agreeing to sell it in the future, it is a reverse repurchase agreement. So they have the advantage. It's like the bonds that they're handing over is the collateral, the security, and the ownership of the bonds transfers until it's paid. So, if the person defaults, you've got the bonds there, and usually the RBA does some interesting things with different percentages. But that's a simplified version of it. We'll have a look at a little bit more. Key takeaways. A repurchase agreement, or repo, is a short-term agreement to sell securities in order to buy them back at a slightly higher price. The one selling the repo is effectively borrowing, which is the bank here today, the banks, and the other party is lending. Since the lender is credited the implicit interest in the difference in price from the initiation to repurchase. Repos and reverse repos are thus used for short-term borrowing and lending, often with a tenor of overnight to 48 hours, which is interesting, where if we look here, 17 to 95 days, so that doesn't seem that short-term. I guess it is. The implicit interest rate on these agreements is known as the repo rate, a proxy for the overnight risk-free rate. So one thing we'll jump to again, we'll have a look here, and this is from our Reserve Bank, and I'll give you a link to this. But there's a good little diagram here, the structure of a repo. So the repo start date. So the security provider provides the bonds to the cash provider, and then the cash provider provides the cash to the security provider. And then at the unwind date, which we're seeing is, say, in 17 days' time. So what's that now? It's the 13th, so it would be what, 30th? Then they'd have to do that, and then have to pay the interest rate back. Okay, they get the cash plus interest, and then they get their bonds back. Now, this is good because it allows the security provider to, lend on their bonds, and then still getting the bonds back, and have access to the, cash value or something equivalent to the cash value of the bonds. And it allows, the cash provider in normal circumstances to make money on their, say you got $1 million, you want to lend it out, you can do that overnight, easy way to make some money, very low risk. Now, with the Reserve Bank, it's a little different story, isn't it? Where does the RBA get their money from? I wonder. So we'll have a look here. Just read this. A repo is an agreement between two parties under which one party sells securities to the other with a commitment to buy back the security at a later date for a specific price. See Figure 1. The difference between the sale price and the purchase price reflects the rate of interest to be earned by the cash buyer. And another thing I'd like to draw your attention to, and I'll give you a link to this article this paper if you'd like to go through it. So if we go down here, the structure of the domestic repo market. The repo market plays a significant role within the domestic financial market. For many investors managing large or varying cash balances, repos offers a lower risk alternative to other money market instruments. By holding a title to securities, the cash investor's exposure to the counterparty is significantly reduced. So this is the benefit of it. Repos are the main instrument used by the Reserve Bank in its domestic market operations. And as the bank is usually buying securities at these operations, it typically takes the role of cash provider, as per Figure 1. Through these operations, the bank alters the supply of exchange settlement funds so as to keep the cash rate as close as possible to the board's target for monetary policy. Buying securities under repo provides the bank with a low-risk instrument for market operations and allows greater flexibility than outright security purchases, because repo terms may be adjusted to manage future cash flows and alter the projected supply of ES funds. Holders of debt securities can use repos to manage their short-term funding requirements. Selling via repos allows them to raise liquidity without having to sell assets outright, thereby maintaining their position in the securities. Investors can also use repos as a means to enhance returns in a securities lending portfolio or as a source of leverage. So let's just theorycraft here. And, if you're interested, I'll give you a link to this and you can go through this in your own time. And I think we all should, because, how many people know about the repo markets? How many people that are reading news.com know about it? So I'll put a theory to you all. Do you think this increase in the repo today on Friday somehow influenced the sharp climb in the stock market today? Let me know your thoughts and opinions in the comments below. And we'll have to wait and see. I wonder what will happen next time. Do you think they'll increase it again? Is this our version of not QE? Just like what America was doing. Because what would have happened to the bonds if no one was there to buy them, if the RBA wasn't buying them? I wonder. Let me know your your thoughts in the comments below, guys. Please like, share, and subscribe to the channel. If you're a fan and you want to support us, there are a few ways you can. Share the videos, get the content out there, help the channel grow. You can support us financially by joining the channel here on YouTube or joining it on Patreon for a small monthly fee. You can use our affiliate links at Amazon or eBay, perfect for all your online purchases. We receive an advertiser's commission, doesn't cost you a cent. We also have affiliate links with Kucoin and Independent Reserve for the crypto traders out there. We also have merch available from the HeiseSays website, Pocket Squares. You can see behind me there. I'll point to it right once. And from Teespring now we've got coffee mugs. I've got one ordered and I will show you the sample once I get it. Finally, we have PayPal if you want to contribute that way. Thanks everyone. Have a great day and I'll see you next time. Bye for now.